Hello everyone, this is Victor here. Welcome back to the Intelligent Investor channel. Several subscribers asked me to analyze PayPal stock to see whether PayPal stock will eventually recover or PayPal stock is a value trap. Just to give you some context, right before making this video, PayPal released its latest earnings. The company did beat its earnings expectations in almost every category except its operating margin guidance. Management gave a slightly lower operating margin guidance than the market's expectation, and the stock was down as much as 12% right after earnings. Management said this: based on the expected contribution of unbranded processing volumes to our growth, we now expect at least 100 basis points of operating margin expansion in 2023. Management expects that PayPal's operating margin will expand about 100 basis points or 1% in 2023. This is 25 basis points lower than PayPal's previous guidance. In my opinion, I think the market overreacted to this slightly lower guidance. If you're interested in PayPal stock, I think the most important question is this: will PayPal stock eventually recover, or is PayPal stock a value trap? At the time of making this video, PayPal stock has dropped as much as 80% from its peak in July 2021. During the peak in July 2021, PayPal's market cap was nearly 357 billion. Now PayPal's market cap is at 75 billion. Also in the past 5 years, you can see PayPal outperformed the S&P 500 substantially during the pandemic, but it has underperformed the S&P 500 by a very large margin since the peak in July 2021. So in this video, I'm going to talk about these topics to see whether PayPal stock will eventually recover or PayPal stock is a value trap. I will talk about PayPal's most recent earnings, PayPal's growth and profitability issues, will PayPal stock turn around, PayPal stock valuation, and will I buy PayPal stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members grow their stock portfolios to over 7 figures over time. Once you become a Patreon member, you can follow all the stocks I'm investing in for the long term and download the latest intrinsic value calculators for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Before talking about whether I think PayPal stock will eventually recover, I want to show you PayPal's latest financials here. PayPal earns around 90% of its total revenues from transaction revenues. PayPal earns transaction fees whenever transactions are processed through PayPal's branded and unbranded payment platforms. The rest 10% of total revenues are from other value-added services, such as interest income earned from business loans, PayPal's buy now pay later, and deposits in customers' accounts. Obviously, during the pandemic in 2020, PayPal's total revenues were growing at very high double-digit rates almost every quarter because everyone had to stay at home and work from home. Everyone had to shop online instead of going to offline retail stores. If you like to shop things online, you will notice that PayPal checkout is very popular in online shopping, but PayPal is not widely accepted in many offline retail stores. In my opinion, I think this is PayPal's biggest weakness. Since the peak in 2021, you can see PayPal's revenue growth has slowed down significantly because e-commerce sales have slowed down a lot. Many people have shifted their purchases from online stores to offline retail stores again. For example, in the most recent quarter here, PayPal's transaction revenues only increased 6% year over year, and its total revenues only grew 9% year over year. For PayPal's business to grow again, PayPal needs to grow these operational metrics: the number of active accounts, number of payment transactions per active account, total payment volume or TPV, and transaction margin. These are the most important metrics that will drive PayPal's revenue and operating income growth going forward. PayPal's growth has pretty much stalled for many quarters already. This is why the stock is down as much as 80% since the peak in July 2021. For example, in the most recent quarter here, PayPal had 433 million active accounts. Active accounts even declined compared to the last quarter. Active accounts growth was flat year over year. PayPal initially had the goal to reach 750 million active accounts by 2025, but management decided to abandon this goal in early 2022 because PayPal was spending too much money on incentives and rewards to attract newer users that were not profitable at all. Many of these newer users were only taking advantage of PayPal's incentives and did not spend enough on PayPal. Now, one of PayPal's main strategies is to increase the number of transactions per active user in instead of using high incentives and rewards to attract newer users like before. If you look at this total payment volume here, it appears PayPal's new strategy is working. PayPal's total payment volume grew 10% year over year in Q1. Both transactions per active account (TPA) and transactions grew 13% year over year. Again, active accounts did not grow at all. It was almost flat year over year. These data seem to suggest that PayPal is growing again, but this is not the full story. According to this article here, the 13% growth in transactions per active account (TPA) was predominantly driven by transaction growth from Braintree, with contribution from core PayPal. PayPal's recent transaction growth and total payment volume growth are mainly driven by PayPal's Braintree platform instead of PayPal's primary branded platform. Braintree is PayPal's unbranded payment platform for merchants and is less profitable than PayPal's branded payment platform for merchants. Here's the full story. Even though PayPal's transactions per active account grew 13% year over year and total payment volume grew 10% year over year, PayPal's transaction margin decreased year over year because most of the transaction processing growth is coming from Braintree, which is less profitable. For example, PayPal's transaction margin was 47.1% here compared to a 50.9% transaction margin in the same quarter of last year. Again, this shows most of PayPal's growth is from PayPal's unbranded payment platform, Braintree, which is not as profitable as PayPal's branded payment platform. This will be an issue if Braintree continues to drive most of PayPal's total payment growth and transaction revenue growth because this will likely decrease PayPal's operating margin going forward. In recent quarters, like many other companies, PayPal has been cutting costs, laying off thousands of employees, and reducing operating expenses. This is why PayPal's operating margin improved year over year in the most recent quarter here. Management expects that there will be at least 100 basis points or 1% of operating margin expansion in 2023. This is 25 bips lower than the market's expectation. In my opinion, I think PayPal has a very healthy balance sheet. For example, in the most recent quarter here, it had $15.3 billion of cash and investments, while it only had $10.48 billion of long-term debts. Obviously, PayPal is no longer a fast-growing fintech company like before. PayPal seems to be pursuing growth, specifically transaction growth and total payment volume growth, even at the expense of having a lower transaction margin. Of course, the market does not like this at all. This from the Wall Street Journal. It explains PayPal's growth strategy and the amount of competition PayPal is facing right now. The bad news is that this shift in growth drivers is pressuring PayPal's operating margin growth. PayPal earns more when a consumer clicks a branded PayPal or Venmo button to pay. Unbranded processing volume, where PayPal's Braintree unit competes with other fast-growing payments processors such as Adyen and Stripe, grew 30% year over year on a currency-neutral basis in the first quarter. This is an enterprise business where signing a chunky new client can greatly accelerate growth and where digital upstarts are eating share from older incumbents. Meanwhile, branded checkout payment volume grew 6.5%, though notably that was 2% points faster than the fourth quarter. Here, PayPal is competing more fiercely than ever, often consumer by consumer, with a growing array of players including fast-coming Apple Pay and offerings from Google, Shopify, Amazon, and more. Growth has also been hit by a broader slowdown in e-commerce shopping post-pandemic. As for higher rates, they are great for margins, as it basically means free additional revenue on the same business. But the issue here is that the Federal Reserve may soon stop raising rates or even start cutting them. This means PayPal is going to face tougher margin comparisons later this year. PayPal lowered its forecast for 2023 adjusted margin growth from 1.25% expansion to 1%. Revenue is anticipated to increase quickly enough to help adjusted earnings per share rise a bit faster than previously anticipated, at 20% year over year versus 18% in the prior guidance. But with unbranded Braintree growth likely to moderate at some point, investors' confidence in continued strong earnings growth may still hinge on margins. This helps explain why PayPal shares are down around 10% Tuesday morning. At the time of making this video, PayPal still has around 40.59% market share in the online payment processor market. PayPal is facing a lot of competition from other payment processors such as Adyen, Stripe, Shopify Pay, Amazon Pay, Square Payments, Apple Pay, and Google Pay. Going forward, I think PayPal will likely have single-digit revenue growth rates in most quarters. This is because PayPal has a lot more competition in both branded payment checkout and unbranded payment processing services compared to before. In terms of revenue forecast, Wall Street analysts expect that PayPal's revenue will grow between 7% and 10% each year over the next 3 years. I think this is a reasonable growth forecast. In terms of EPS forecast, Wall Street analysts expect that PayPal's EPS will grow at double-digit rates over the next 3 years. This EPS growth forecast assumes PayPal will continue to improve its operating margin over the next 3 to 5 years. This also assumes PayPal will continue to buy back a lot of shares with its free cash flow every year. I want to show you PayPal's profitability financials here so you will know whether PayPal's business is very profitable compared to other competitors. If you look at this here, you can see PayPal's EBIT margin or operating margin is better than Adyen and Block. Adyen and Block are two of PayPal's biggest competitors. PayPal's levered free cash flow margin, return on equity, and return on total capital are much lower than Adyen's, but they're much better than Block. However, if we compare PayPal's profitability financials to Visa and MasterCard, you can see Visa and MasterCard's businesses are much more profitable than PayPal's in every category. This shows Visa and MasterCard have much better business models than PayPal. So will PayPal stock eventually recover? Overall, if I have to make an educated guess, I believe PayPal stock will eventually recover if PayPal continues to expand its operating margin each year and grow its total value by 7% to 10% each year. Of course, I cannot predict how long it will take PayPal to recover. Personally, I don't think PayPal stock is a value trap because PayPal's business is still growing but at a much lower rate than before. The biggest concern right now is whether PayPal can improve its operating margin going forward. Again, PayPal's management expects that PayPal's non-GAAP operating margin will improve at least 100 basis points or 1% in 2023. This is 0.25% lower than what the market initially expected. PayPal's non-GAAP EPS is expected to grow 20% year over year in 2023. This is almost the same as Wall Street analysts' EPS forecast I showed you earlier. PayPal's free cash flow is expected to be around $5 billion in 2023. This is almost the same as 2022's $5.1 billion free cash flow. At the time of making this video, PayPal's total payment volume growth and transaction value growth are mainly driven by Braintree, which is PayPal's unbranded payment processing platform. The problem is that Braintree is not as profitable as PayPal's branded checkout, so this will likely impact PayPal's operating margin at least over the next several quarters. Based on what I know, when a customer clicks on PayPal's checkout button to buy a product online, PayPal will earn high transaction values from the merchant. In comparison, when a customer clicks on a checkout button that uses PayPal's unbranded processing services from Braintree, PayPal will earn lower transaction values from the merchant. I want to share with you the most important points from PayPal's recent earnings call. It explains PayPal's growth strategy going forward. PayPal CEO said this: going forward, we will primarily focus on enabling unbranded processing and our latest branded checkout experiences through Braintree and PayPal Complete Payments. Second, we will continue to invest to help ensure our unbranded platforms are best in class, enabling our merchants to reduce fraud and increase their sales conversion rates. Third, we're focused on substantially improving the margin structure of our unbranded business. Our PayPal Complete Payments platform opens a new $750 billion total addressable market in the small and mid-sized business market with a significantly enhanced margin structure compared with our largest enterprise customers. Our Braintree and PayPal Complete Payments platforms are also expanding overseas where we can drive higher margins. And we're adding value-added services to our platform like risk as a service, full omni-channel capabilities, payouts, and Forex as a service to both enhance functionality and add incremental margins. And finally, enabling merchants with our unbranded services will provide a constant stream of incremental data to feed our AI engines and fuel our next-gen checkout platform. We anticipated that this combination of initiatives will enable our unbranded services to become a clear market leader, drive additional growth in our branded checkout, enable our next gen of checkout, and provide new sources of margin growth. Finally, I'd like to briefly touch on the search for my successor. We still plan to announce my replacement before year-end, and the process is well underway. Hopefully, the next CEO will help PayPal turn around much faster. For PayPal to turn around, I think the key is improving PayPal's operating margin going forward while maintaining a revenue growth rate between 7% and 10% each year. I want to show you how to calculate PayPal stock's intrinsic value here, so you will know when PayPal stock becomes undervalued, fairly valued, or overvalued. If you want this calculator, you can download it from my Patreon blog. These are the key assumptions in this calculator. First, I define PayPal's intrinsic value as its future free cash flows discounted to the present day. I used a discount rate of 11% here. You can use a higher discount rate here if you want to be more conservative. I expect PayPal's free cash flow margin will be slightly lower at 16.5% over the next 5 years. This assumes PayPal's total payment volume and transaction revenue growth will continue to be driven by PayPal's unbranded payment processing services. Over the next 5 years, I believe PayPal's revenue will grow at a compound annual growth rate CAGR between 7% and 10% each year. I think this is a very reasonable revenue growth forecast. It's also consistent with the Wall Street analysts' consensus revenue forecast I showed you earlier. Let's go over these 3 case scenarios here: worst case, normal case, and best case scenarios. Under the worst case scenario, we're forecasting PayPal's revenue will grow at a CAGR of 7% over the next 5 years. If we forecast PayPal's free cash flow over the next 5 years and discount the free cash flow to the present day, PayPal's intrinsic value should be around $190 billion for the entire company or $105 per share. I'm giving this scenario a 25% probability here. Under the normal case scenario, we're forecasting PayPal's revenue will grow at a CAGR of 8.5% over the next 5 years. Then PayPal's intrinsic value should be around $126 billion for the entire company or $111 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're forecasting PayPal's revenue will grow at a CAGR of 10% over the next 5 years. Then PayPal's intrinsic value should be around $134 billion for the entire company or $118 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, PayPal's intrinsic value should be around $111 per share. I also used a price-to-book valuation model here to estimate PayPal's intrinsic value, which should be around $110 billion for the entire company or $97 per share. If we take the average of both valuations here, then PayPal's intrinsic value should be around $104 per share. In comparison, most estimated PayPal's intrinsic value to be much higher at $135 per share. This means I believe PayPal is greatly undervalued at the time making this video. So will I buy PayPal stock? Personally, I'm not planning to buy PayPal shares in this portfolio here. I sold my PayPal stock in this portfolio many months ago and made a 52% gain when I sold it. Even though I think PayPal is likely greatly undervalued, I think many companies have better business models that are more profitable, have larger economic moats, have higher growth rates, have higher operating margins, and have better free cash flow growth than PayPal. For example, I like Visa, MasterCard, and American Express business models much more, so I will likely buy more Visa, MasterCard, and American Express shares going forward, whenever they become greatly undervalued. I also like Adobe's business model, its large economic moats, and how profitable the business is. I bought more Adobe shares recently because I believe Adobe is greatly undervalued based on my intrinsic value calculation. I have other portfolios that have almost the same stocks and the same investing strategy. I still have a very small position in PayPal in a separate portfolio. It's less than 1% of the portfolio, so I'm planning to hold it until it recovers. I'm not too worried about it because it's only less than 1% of the portfolio. Overall, I think PayPal will eventually recover as long as it continues to improve its operating margin and grow its total revenue by around 7% to 10% each year. Hopefully, the new CEO will help PayPal turn around much faster. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.